online attendance. See. I have John and Gus to go through the BTC report. So I will turn it over to John. Go ahead and go through the report, John, and if we have any questions, we'll jump in. You're muted, John.
And can I ask, was this report, was it sent to us? Is it somewhere that I can easily access it? Or is this the report from previous months?
This is the March report, and I believe Rosie had put it out in the documents, Rosie.
Yep, it is.
It should be in board docs.
Okay, I just wanted to check where it was.
Thank you.
This is Alan. I can share my screen too if that helps.
That's helpful.
Okay, let me do that. Here we go, I think. Can you see this? Can you see the cover page, everybody?
I see a sign-on sheet.
Oh, that's weird. Let me go. Can you see it now?
I can see it now.
Yes.
All right. Okay. So John Augustine, our Chief Investment Officer, is with us today, and so he will discuss part of the presentation. And Jeff Beardsley, the head of our fixed income team, is here as well. With that in mind, I'll start. And we'll talk about investment policy statement compliance first before moving on to the other parts of the report. But lots of numbers on this page. I'll just hit the highlights. So as of March 31st, the cash level was 2.1%, and you can see that in the upper right in the current column. That's within the IPS policy ranges of 0 to 10%. Fixed income was 71%, almost 72%, which is between 60 and 90, the minimum and maximum weights allowed in the investment policy statement. Excuse me. And then there are the various weights within fixed income in terms of credit quality. It's broken down by credit quality. The idea is that there needs to be a lot more weight in the upper credit quality than in the lower credit quality, and that's the case as shown in the IPS range and current columns, which give you a sense of what's allowed. It's in the IPS range column, and then the current weights. You can see that those current weights are all within the guidelines, so no issues there. Moving down the page, equity is a 26.2% weight as of March 31st, and that's within the guidelines of a 10% minimum and a 30% maximum weight. And then there's that category is broken down into U.S. large cap, U.S. small cap, real estate, and international. And the portfolio is in compliance with all the guidelines specified in the IPS range column. So everything looks good there as well. And then finally, other limitations in the bottom 1/3 of the page or bottom 1/3 of the table. Just a couple highlights here. The investment in any one corporation, it can't be any more than 2% of the weight of the entire portfolio, and it's 1.9%. That's Walmart, where we not only have stock exposure, but bond exposure as well. So that's been the case, and anybody that's been on this call for a few quarters knows that tends to be our largest weight on an ongoing basis. Any thoughts or questions on any of the data on this page? Everything's in compliance with the guidelines specified in the investment policy statement. So no need to make any changes to the portfolio related to factors. So everything looks good here. Any questions, thoughts? Okay, moving on. The asset allocation. As of March 31st, on the prior page gave you the specific weights, but here in the table in the upper left, we have the market values as of March 31st, and cash and equivalents were a little over 4.5 million for 2.4% of the weight. Taxable fixed income and tax-exempt fixed income collectively were a little over 136 million. So that's the bond portfolio, 136 million. representing almost 72% of the weight of the portfolio. And then we have the market value of each of the equity asset classes. In the remainder of the table, U.S. large cap equities, which are the most stable portion of the equity market, they make up the largest weight in the portfolio, $35.6 million worth as of March 31st, and that represented almost 19% of the portfolio. And then you can also see here that small cap REITs, which are real estate investment trusts, foreign developed equities, and foreign emerging equities, they're all much smaller weights and are what we would consider to be complementary to that U.S. large cap stock weight. So as a reminder, the purpose of the fixed income portion of the allocation is stability within the portfolio, as well as delivery of income. The equities, primary purpose is growth or appreciation of the portfolio. They also provide income through dividends. So dual purpose asset classes, or asset portfolio having two drivers of total return, income and appreciation. And then finally for this page, in the bar chart in the bottom right, excuse me, bottom left, not bottom right, bottom left, that bar chart, the broken bar chart, shows that the asset allocation has been fairly consistent over time. So each of these bars is as of March 31st of the corresponding year on the x-axis. And what I mean by stable, I'm looking at that navy blue portion of the bar. You look at the last 4 years, that size of that navy blue portion of the bar has been pretty constant. That little green portion is very constant as well. And then that bigger portion, gray, is constant as well, deviating only a few percent. And the navy blue is U.S. large cap stocks. The gray is taxable fixed income. And then the green is foreign equities. And so what we're looking for is stability of those bars. That suggests that the weights aren't changing much, and that translates to the risk of the portfolio remaining constant, fairly constant as we move through time. Despite market volatility, the risk in the portfolio has been fairly constant, which is an important part of managing the portfolio. You want that to happen. So markets go up and they go down. But still it can be done in a risk of that's what you see here, constant weights leading to a reasonable level of risk that's fairly constant. Any questions or thoughts before I turn it over to John to talk about performance? All right. Here we have the account return page, and it will focus on the data in the table in the bottom half of the page, and I'll turn it over to John to talk about the details here. So, John, please share your thoughts.
Okay, thank you, Alan. Taking a look at the information at the bottom of page 4, you can see for the 3-month period that ended March 31st, the portfolio returned 3.05%. So we did see some positive movement after that tough year last year, particularly on the fixed income side, which had a very uncharacteristically tough year in 2022. We did see some recovery in the fixed income markets, and the equity markets also, for the most part, contributed positive returns during that period. You can see once again the return was 3.05. Taking it out to the 1 year, you continue to see the lingering impact of what we went through last year, where the portfolio was down 4.79%, and then you can carry that out to the right for the longer term time periods. On a relative basis, you can see that the performance at the total fund level has been higher than what you've seen for the benchmarks, or less negative in terms of the negative period of the 1 year return. So that's good to see that the portfolio, as it's constructed, is doing well relative to that unmanaged benchmark. The cash and equivalents, we're actually starting to see a little return from that this year as short-term interest rates have gone up. When you look out to those longer-term periods, you see the return was less than 1%. For the 3 months, we had 1.28%. So that's just for a quarter. So there's been a dramatic increase in those short rates, which is very helpful for any of the balances that are in the cash and equivalents. Fixed income, once again, also recovering for the period, 3.7% return in your portfolio for the quarter, just under 3% for the benchmark, the Bloomberg Aggregate Bond Index. So good relative performance there, and obviously good to see the return to positive performance for that part of the market. The tax exempt fixed income up over 5%. And as we've talked about, it's really not tax exempt. They're taxable municipal bonds. And always, if you have questions on those, don't hesitate. And particularly since we have Jeff on the call today, he is the individual who manages the fixed income portion of your portfolio. Looking at the U.S. equities, up fractionally for the quarter. That compares to the benchmark of -1%. And then you can see the foreign equities were actually up 8.8% versus a benchmark of 8.47. That is one of the things that we have seen this year, a little differentiation from what we've seen the last few years. We've seen particularly the established international markets performing well. The differentiation between those in the U.S. has diminished somewhat over the last few weeks, but we have seen better performance from them as well. So any questions on the performance before we move to the individual asset class information? Okay, hearing no questions, we'll turn to page 5, and Jeff Beardsley will come on to talk about the fixed income component of your portfolio, obviously the overwhelmingly largest component of your portfolio.
Hey, Jeff, you're on mute.
It's an epidemic.
Rewind. Something's not, can't hear you still.
He's not muted. Try plugging your plug-in. Make sure it's plugged in tight.
Jessica.
Well, I'll tell you what, if Jeff's not able to hop on the call, I can walk through this. And Jeff, if you get the opportunity to jump in, please do. But I'll go ahead and go through this and able to keep the meeting moving. When you look at the information on page 5, you can see in the upper left-hand corner the fixed income characteristics, the portfolio versus that Barclays aggregate bond index. And you can see the yield to maturity or call at just under 5% compared to the benchmark at 4.4. The current yield at 4.9% compared to the benchmark at just under 3.1. So significantly higher yields in your portfolio than what we're seeing in the benchmark. And the average quality just about the same, just a little lower at A1 relative to the benchmark at AA2. The average maturity, 9.26 years compared to the benchmark at 8.58. That was beneficial as rates came down. Having that longer average maturity and a duration that was equal to the market allowed you to participate in that upward move in bond prices and a lowering of the yields that went along with it, creating that total return that was ahead of benchmark for the period. In terms of the sector allocation, as you look down that column under the portfolio heading, you can see the majority of the assets in the bond portfolio are in corporate bonds, over twice as much as the benchmark. The reason for that is we do get higher yields within the corporate sector relative to the government sector. And as you can see, as you look higher up in terms of that column, Treasury and other government only about 4.5%. Relative to that, almost 60% in corporates. And then we do have a significant block of municipal bonds. Once again, those are taxable municipal bonds, not tax exempt like you would buy as an individual. So scrolling down in terms of the quality distribution, you can see a little over 22% in the AAA area, about 22% in the AA, 37% in the single A, and then we have 18% in the BBB. Everything, of course, BAA or BBB and higher is considered to be investment grade, and there's just 1.2% at that BA or BB level. So a very high quality portfolio, as we touched on a moment ago, generating some good performance for you. And once again, focused on corporate bonds and the taxable municipals to lock in some better yields than what you can find in the government market. Any questions on the fixed income component of the portfolio?
I do have a question, which is sort of the short and long-term play. You know, as we look at a lot of short-term right now, yields are quite hefty, especially in comparison to anything the last 2 decades. what should we anticipate in terms of any shifting? Will we see more short term? Will we see some of our call to maturities come down, or as a team, are you feeling on that steady track of more of those 8 and 10-year type bonds as we've had for quite some time?
Yeah, right now, and Jeff, are you on?
Yeah.
There
Can you
he
hear
is.
me now? All right. So awesome. Yeah, we're not going to play the short game because it's going to go away. It's one of those things that would go away. And if short-term rates come down, the opportunity to invest at the yields that we have today may not be there. So we're trying to take advantage of that portion of the yield curve that suits best for the liabilities of the overall portfolio. Try to take advantage of some of the higher yields, which right now our reinvestment yields are above the 5% number, and they are also above the current book yield. So everything that we're adding right now is an increase to the income component associated with the portfolio. So we are kind of sticking with that 6.18. We're trying to go maybe a little bit longer in duration in anticipation of capturing some of those higher yields for a longer period of time.
Can you share what are some of those reinvestment rates that you're sort of seeing or have seen in the last quarter?
Yeah, you bet. One area that we've been underweight relative to the benchmark is mortgage-backed securities. So that is one area where we made some additional investments. Those yields have been around the 5.3% area. Some are a little bit lower, where our anticipated total rate of return, we believe, will be closer to, again, to that 5.30, 5.40% area. So that's where we've been focusing, is adding those. Those are AAA rated. They are relatively inexpensive compared to where they have been in the past. And that's why we've been adding to that sector, because of their relative value compared to the corporate bonds that are in the portfolio and the taxable municipal bonds.
Does that make sense, Blake, the short term versus the long term? Because I think the way I think based on past conversations, you're probably following this, but it's a common question, and I talk about it a lot with clients. They often ask, well, gee, the one year yield or rate you can get on a 1 year bond is higher than a 5-year bond. Why don't you just take the 1 year all day? And the answer is because the 1 year could be significantly less than the 5 year 12 months from now, when I've got to renew that 1 year bond. So I'd rather lock in a 5-year bond that's paying slightly less than a 1 year bond, because there's a strong possibility that if you lock in the 1 year, sure, you got a better yield for 1 year, but then it's not as good for the next 4 years. And in the end, you end up making more over the 5-year period by taking that 5-year bond today. I don't know if that makes it any clearer or not, but
No, I understand it.
most people don't. So
I get it. I want to hear those answers, because I think, when we look at, there's a significant amount of money in this total plan. I think it's important to see and to be able to address that, and it's not that we're not at all trying to address those short terms, because a lot of that is actually in the cash portion when you look at it, and it's to help paint that picture of really the holistic side of what we're doing, and that overall, as I look at this, assuming that the bottom doesn't drop off into some area, we are inching, which is what we've always talked about. We're moving, incremental steps forward in terms of the overall growth of the plan.
That's exactly what's going on. And again, incremental is the key word, because we're not selling bonds and buying new ones. We have to probably take a few losses to do that. And by the time you do that, they offset the gains. Bond math is pretty precise. The bond world is pretty efficient. We could sell bonds, but we'd incur losses, and any gains we'd pick up on the new ones. The gains would offset the losses. So incremental, meaning when bonds mature, the team is very careful to not just jump at those short rates and look at the rates of longer term bonds, because again, over a 5 or 6 year period, we're going to be most likely be further ahead by having bought that 5 to 6 year bond or even longer, and not just taking that what seemingly is such an attractive situation and buying a 1 year bond or a 2 year bond that we're likely to have to reinvest at a lower rate. So I'll stop there.
Well, and can you talk about, as we've seen interest rates continue to climb, the hope is that at some point that those interest rates will begin to either level off or begin to fall. What kinds of changes should we and expect to see when that occurs? Because whatever the science teacher's wisdom is on this would say that we might see that change, quicker than what we did back in the 70s and in the 80s.
Go ahead, Jeff.
Yeah, so, what we do, right now, the Federal Reserve recently made a change on May 2nd, where they did increase the short-term rate, what they charge banks for blending overnight, to 5.25%. Right now, it is anticipated that will be the last rate increase that they will make. So as a result, and now what we call Fed funds futures, these are contracts out in the futures, the market is telling us that at some point later this year, they may actually have to reverse course and start lowering rates at that time. When they do that, what we do anticipate is that there'll be stability in the market value of those assets that we're buying that are a little bit longer term. And that while there might be some short-term gains from the decline of interest rates at the short end, those yields will go away, just as Alan pointed out. So we do anticipate that interest rates in general that are very high right now are going to come down. Things like mortgage-backed securities, things like that, you will actually start seeing some of those mortgage rates come down as well. And that's why, again, it's a good opportunity to invest in that space because they are offering very good yields within mortgage-backed right now. So yes, we will be making changes as our duration and then as the shifting of the interest curve does. As the curve changes, we will make some shifts within the portfolio. Yes.
Any other thoughts on fixed income before we move on to equity? Okay. On to equity. So equity large cap value on page 6. John, what are your thoughts here?
Sure. Just taking a look at the portfolio structure in terms of its characteristics in the upper left-hand corner. I think we've discussed this in the past. What we really strive to do with this section of the portfolio in terms of large cap value is focus on the valuation and the income that is generated from this part of the portfolio. When you take a look at the price earnings ratio, which is a valuation measure for equities, you can see as of March 31st, it was 14.1. That's lower than the benchmark or the same ratio, excuse me, for the benchmark, the MSCI USA Value Index. And that's one of the metrics we really key on, and we want to keep that lower. We're really focusing on valuation. The other metric we key in on is income. And as you can see, the dividend yield as of March 31st was 2.87 compared to the benchmark at 2.69. So just under 3% in terms of the yield you're getting on this portion of your portfolio. So directly below that, you can see the breakdown in terms of what is comprising that segment of the portfolio. The biggest segments of this part of the market are financials and healthcare companies. And of course, financials have had a lot of publicity of late in terms of what's been going on with some of the regional banks. We still have some exposure there. We're comfortable with what we have. We have made a few tweaks, but overall, we're still pretty comfortable with it. Technology and industrials are also significant components of this part of the portfolio. Technology has been the strongest part of the market so far this year in a reversal compared to what we experienced last year. Bonds and technology companies had the similar pain of seeing lower valuations over the course of last year. And as we touched on with bonds and with technology companies, they have both benefited from a recovery so far this year, technology in particular. So when you go over to the lower right corner, you can see the top 10 holdings in that segment of the portfolio as of March 31st. Top holding being Procter & Gamble, followed by an energy company, specifically a refiner, Valero Energy, AbbVie, which is a pharmaceutical company, as is Bristol Myers, and Gilead Sciences. And then we have some technology exposure there, Cisco Systems being a significant holding, as is Walmart, ExxonMobil, JP Morgan, and Johnson & Johnson. JP Morgan, obviously, so far has been the beneficiary of some of the turmoil in the banking industry. So having exposure there has been a benefit to the portfolio. Any questions on the value segment of the holdings? If not, we'll go to the small cap segment on page 7. And once again, in that upper left-hand corner, you can see the statistical comparison between the strategy holdings and the benchmark, the MSCI USA small cap. Once again, we do have a lower price to earnings ratio. We really do kind of strive to do that across all of our strategies because we are very value conscious and want to make sure we're not overpaying for the equities we have in our various strategies. And in terms of looking down below that portion of the page, the sector allocation, you can see the larger segments, once again, financials being a large component, industrials being the largest, and then technology also a healthy part of that, along with consumer discretionary. So our weightings are, for the most part, not too far off in terms of how we're positioned relative to the benchmark. We're off a little bit here and there, but for the most part, we're not too far off. Materials would be one where we are somewhat significantly lower at 3.9 relative to 5.4. So that's one of the outliers in terms of differentiation between us and the benchmark. And then, of course, you do have the top 10 holdings in the lower right corner. Not as easily recognizable as those we saw in the large value strategy, but some of them a little more front and center. FMC Corp is a fertilizer company primarily. BJ's Wholesale Club is, as its name implies, a wholesale club. Then you have a couple of energy companies in terms of Viper and CBR Energy as well. If there's no questions on the small cap, I'll head to the international component. Once again, same format, upper left corner. And you can see, once again, the price earnings ratio lower for the strategy relative to its benchmark, and the dividend yield higher. I should say roughly the same at about 3%. The benchmark at 3.1, dividend yield of just under 3% for the strategy. So when you look at that large cap value, you look at the international strategy here, you're getting some significant income from the equity holdings, along with the potential for some price appreciation. Not a lot of deviation, once again, from the portfolio, from the sector holdings within the benchmark. When you take a look at materials, once again, probably the biggest deviation relative to what the benchmark holding is, and then the top 10 holdings over in the lower right-hand corner. So even some of those a little recognizable. Unilever, a big consumer products company based outside the U.S., and of course Nestle, a global food company. The next page takes a look at the real estate holdings, actually specifically REITs, real estate investment trusts. And you can see when you take a look there, the dividend yield in that upper left-hand corner is 5.7%. That's why we incorporated real estate as a separate component of your portfolio, was the ability to enhance the income relative to the other major asset classes like the equities and the fixed income. So obviously doing that job at 5.7%. Strategy all invested in, once again, real estate investment trusts, and the top 10 holdings in that lower right-hand corner. So good, once again, income level being produced by this portion of the portfolio as well. With that, I will once again ask if you have any questions in regard to portfolio characteristics or construction.
Do you see any changes in our REIT strategy? And I pose that because I think about, the overall market conditions in terms of, where interest rates are. Do we see there being a change in the REIT investment pieces, components, and percentages?
I'm not so sure that we will see any changes in the percentages. Very much you could see some changes in the composition of what is in there, because obviously we've seen a lot of movement within real estate. So for example, one of the major themes going on right now are the vacancies in office buildings. As working from home continues to be a sizable component of the working population for some companies. So the need for office space is not as great as it was prior to the pandemic. So that's an area to be looking at. And so that's just an example of the types of things we would be looking at in terms of what comprises that part of the portfolio.
Any other questions before we sign off? Let's see here, I see something in the comments box. Oh, it's just a note from Jessica. So,
Yeah, just me.
okay. Well, if there aren't any questions, we will leave the call and leave you to the remainder of your meeting. But if you think of something afterwards, feel free to route those questions to me through Kathy, and we'll see you next month. All right. Thank you,
Thank
everybody.
you.
Thank you very much.
Thank you.
Okay. I'm going to take liberty on the agenda to make a small change. We have on the agenda as the next thing to discuss, to do some more plan document work. Before we do that, I wanted to bring up the 401A for the active participants and kind of what I've found out on that. I know we had talked briefly about it the last meeting. I have done the enrollment forms to get us enrolled with the state into that plan, and I've reached out to them regarding education on that plan, because I'd like to see us not just say, hey, you get a 401A, here it is. I'd like a little bit more of an explanation for members. The state has offered to do a webcast type delivery for us, explaining. Also, they have some brochures that they can get to us to distribute to active members to explain the process. They also had mentioned, and I want to get you guys' feedback on this, the possibility of holding like a vendor fair where agents and representatives from some of the financial companies would be there. My only hesitation with that is it becomes a sales tactic, and I don't like that piece. I don't want anybody to feel pressured as to which company they pick. I'd like them to be able to make those choices on their own, and they still can. I just don't want it to feel like a high pressure situation. Thoughts?
I actually like the idea of potentially having a vendor fair. What I struggle with is how to create a vendor fair date and time where a lot of people could attend, because to me, that's the only way it would actually be impactful and useful, is if, no chance you're going to get 100%, but if you also only get 20%, I'm not sure. I think it's a lot of effort and energy, and then it may create some of that dynamic that you're talking about.
Yeah, I just don't know. When she had sent that, actually just yesterday, or maybe even this morning, and said we could do, we could maybe help coordinate a vendor fair and blah, blah, blah. And I'm thinking, number one, we're at May 10th, and our audience trails off very quickly here in a month, as it should. I mean, people should get their summer and shouldn't have to be doing this type of stuff during the summer. But if we could roll out quickly some webcasts and maybe even an opportunity for some questions and answers in a webinar, I feel like that might be the best solution, because it can be rolled out quickly and people can attend it. We could record it for those who can't, and put it out as an offering. But I am not opposed to the other either. I'm concerned about time.
Yeah, or I wonder, Kathy, if any of the vendors would provide to us whatever in electronic format, you know, their brochures or a video as well. So it sort of, it gives them that opportunity to do their pitch, and people could access it at their will. What I worry about is that, you know, we have the webinar, but ultimately what people are going to say is, how do I know which one to choose? And that's where, you know, that rubber meets the road, is then you're making that choice and selection. And, you know, how do we get people the most information that we can without, I get that, like, we don't want to have that salesy, that's not our component. But how do we make sure that people have the information that they need in the time that they're going to need to make that decision? Because Kathy, when will people need to make that decision?
Well, that's the other thing. I've got a couple different thoughts on this. We said it was effective July 1. So I can, in order to do July 1, I would need to probably have it by June 15th to get it entered in. If it doesn't work to enroll people by July 1, we could do it retro to July 1. That's more work for us, but I also realize it's not the participants' fault that it's May 10th.
I mean, I think realistically, Kathy, we have to think about, I think we either have to try to get it done now, and I would argue even try to get it done by June 3rd, just
Right.
knowing that people are going to be done. Otherwise, if we don't do that, I think realistically, then your commitment won't be until probably September. And I like the idea of, as soon as possible, getting this in place for people, because I think there's also that positive immediacy of this is now in place for you because of just all of the work that all of us have done and the school board has done. And so I would advocate for, even though I know it stinks in terms of the timing, to try to get to where people are signed up before the end of the school year. You could put a June 15th deadline, knowing that that would give a little bit of time, but that as a district, we would really try to target and get all that information out, I would say, as soon as possible, in hopes that people would sign up before the end of the school year. That would be whatever my opinion is worth, that's where I would land.
Your opinion is worth a lot. My next question would be for individuals who don't sign up, because you know we're going to have those. In the TSA structure currently, for the employer contribution, if someone doesn't sign up, we put them in an interest-bearing account with Voya. That's just our default. If you didn't sign up, I'm putting your money here because I don't want to have to babysit you for a year and keep saying it's time to sign up, and then I have to do a retro, you know, for that long. So that's been our default. I don't know, we haven't said anything about a default, but we could on all the enrollment information. Are you guys comfortable with the default of an interest bearing?
Kathy, what happens with a default if I don't like the default and I figure that out, like, let's say it's a year later, is that an easy transfer for me to do?
Yes.
So I would say that I would like the idea of the district creating whatever's the default that makes sense.
And the reason we did interest bearing is I am not going to put somebody in something that could lose money. Because with my luck, that would be what I would pick, and then it would just not be a good situation. So I can work with Jenny at the state about a default option. What I had her do previously, what we did for the 403B was we took the carriers at that time that we were utilizing, and we took the one with the highest interest bearing account, and that's the one we picked. Not real scientific, but that's how we did it. And you know, those rates are subject to change as well, but I think we pick one and we stay with it. And Barb, I see your hand is up.
I just have I'm just curious, how many vendors will there be for the 401A? Is it a limited number or?
It is a limited number. We're on I believe the extended panel, which I think there's 9. So, I mean, there are a fair amount. If we, not all will always participate. Some, according to Jenny today in her email, some will allow enrollment via phone, some will allow it online. So they don't have to be in-person enrollments. You know, you don't have to physically meet with an agent. So that's a good thing. But I think it would be important. And Robbie at the state of Iowa does training on this stuff all the time. And she does an excellent job and is very thorough of explaining the process. Here's the forms we need. This is why we need this form. You need to fill out lines 1, 2, 4, and 7. Sign the bottom. I mean, she's very thorough. So I think that that's what we need. And I can touch base with them and maybe I'll talk to her about what she's done in the past, if she prefers to maybe have 2 offerings and record them. And then anybody who can't come to those 2 would have recordings that they could watch. I feel like we need to offer more than one time. Jessica?
Yeah, I was just going to say, I really like the idea of the webinar. I think that's really helpful because it gives people the information in a neutral way. People will want to also know what their choices are so that if they go to talk to their financial planner, they might get some advice from the person that they're going to be working with that way. So if it's possible to get some advertisement, electronic advertisement from the different plans, so they could say, this is our plan, this is what it looks like, that people could access at their leisure, that would be helpful. And also having a deadline of June 15th to make a decision, I think is a great idea. So
Okay.
I'm concurring with a lot of the stuff, and the default also sounds like a really great idea.
Okay, I will work with the state. I'll reach out to her and see how quickly we can put something together. If I were to put something together, I'm assuming a Monday through Thursday is best. Obviously, I don't think we probably want a weekend offering or a Friday evening. Anytime after 4.
Yeah, I do think Kathy, if the state would do it, you probably could do a Saturday morning offer. I don't know what the attendance would be like there, but I don't think it would be awful.
And it might allow spouses then to participate. So maybe one evening after 4, anywhere from 4 to 6-ish, and then a Saturday morning if available. And I don't know if Robbie does Saturday mornings or not, but I can ask her. Okay, I will work on that. I do know that the state's website has all of the vendor information. You can click through it all and look at everything. I just don't know that people will do that. So I'm wondering if if even Robbie has like a summary or some consolidation of, here's the ones we offer. I don't know. I'm sure she's got better ideas than I do.
If we could just provide them with the link, we could provide people with a link so they could go there. And I'm sure that those who are really interested in this will do their due diligence and check it out. Those that will go to the default anyway are probably not going to check it out. But I think almost everybody else is in the other category. So I think people are going to really fall into one of those 2 groups.
Okay.
Yeah, that's what I was thinking, is the more we can just get the links to people so that they know these are your choices, maybe even get them out as soon as we can. I think on the, if a Saturday option doesn't make sense, I think my ask would be, if you do evenings, is to do them at kind of different times. A lot of times someone, if they can't do 4 o'clock, they might not be able to ever do 4 o'clock. So, maybe a 4 o'clock and a 6:30 or something. So there's a little variation, thinking about when
Okay.
people might be coaching or other activities that they're doing in the evening. That's my thoughts on if there's going to be 2 meetings, which I think is great, to give that flexibility.
And preferably a rainy day, all those things, right?
You could choose a 7 a.m. too. I mean, so people who can want to do it before school. I know elementaries will start checking their kids in at 7:30, but secondaries don't start checking their kids until a little bit later than that. So we could also do a 7 a.m. and a 4 p.m.
Okay, I'll check with Robbie and see what her availability is, because we're kind of at her mercy on this. But I will get something out as soon as I can, touch base with her. And I feel like we have a plan to move forward. The next question I think I'm going to get from people is, what is my contribution amount? And so I'm trying to pull that together because, as you guys know, everybody's contribution amount varies based upon your age at entry of the plan. So I'll try to get a chart ready that we can provide that information to individuals. Is there anything else I'm missing that you think would be helpful for people to have?
If our enrollment or our target is July 1st, when will they expect to see the first installment?
Well, it would come out of their, let's see, if it's July 1, it would start with wages earned July 1. So you guys are 2 weeks in arrears, so those aren't paid till July 15th. So it wouldn't come out until your July 15th check.
Yeah,
I
that
believe.
may be good information for people to know as well, as they do this is like, okay, when will you expect to see? Because a lot of times
July 1 to July 15th is paid on July 30th. So they won't actually see it come out of their check till the 30th. Or it's not coming out of their check, it's just on their check.
Going it, correct.
Yes.
I knew what you meant.
I know, but the recording doesn't, so I had to clarify. So yeah, I could get that together. And actually that gives me a little bit more time. I still will probably use the June 15th date because I think if you don't, that'll give us time to track down people if we need to or whatever. So, okay. I think that answers all my questions there. It is now 4:45 and we're supposed to end at 5. Do we want to dig in to plan document for 15 minutes or do we want to put it onto the next agenda?
I think actually I'll maybe throw one thing out for people. As I looked at all of Article 5, that whole section that goes from page 20 to it feels like forever, until you get all the way into like section 510, I guess I looked at almost all of those distribution methods as my questions just came back to like, is all of that language legally accurate and correct and on track? It was sort of like other sections that we had. And I guess I'd just be curious if others saw the same thing. You know, perhaps that helps us to kind of jump forward significantly. And then that gives us a drop-off point, and then we can kind of say, hey, let's look at the next section at our next meeting. So I guess I'd just be curious as people look section 5 for me all the way to section 5.10 was for me legal jargon questions. So that's page 20 to page 31.
Blake.
Oh, you're on. Oh, yeah.
Yes. I'm happy to see your smiling face. I hope the feeling is mutual. The majority of these provisions are required. You can still change how it's done, but the requirement to describe distributions in whatever format it's going to be is necessary. So, for example, if you looked at distributions upon death and you want it to tinker with how we do that, we can make those substantive changes, but simply saying people will get paid when they get paid, I'm going to advise against. And a large number of these areas are simply kind of in that list of mandatory features of any qualified plan.
That's what I figured it was, and that's why I was like, I go, these all look legal and just need to be there. So thank you. That helps a lot. So
one thing, Blake, I would lift up is I will go through my list of DMTRS issues. I kind of keep a list going and see if there's been questions about, distributions at death. What were those questions, and is there something ambiguous in our language that we could shore up? But other than that, I'm in favor of your jumping forward, and we could use that as our launching point for the next meeting. Everybody good with that?
All good.
All right. My only other thing on the agenda was the active opening that we have on the committee. Blake had given me a name and I reached out, and that individual, just due to the timing of our meetings, really can't participate. So we are in the business of looking for another active member to be on the committee. If anyone knows of anyone who might be interested, please bring their name forward and I can talk with them and see if we can get them appointed onto the committee.
Can I ask, is our next meeting, are we June 14th at 4 o'clock?
A step ahead of me on that. Doug's saying yes.
Yes, it is. Catherine, again, I am not available for that next meeting. I just, for purposes of creating the agenda, if you do like my long-winded explanation of what is essentially legal jargon, I'm going to have to forego that for a month, but I'm happy to answer any follow-up questions after the fact.
Okay, thanks, Catherine.
You can send
And
us
if-
a recording, Catherine, of like, you know, an explanation of something, and we'll just push a play button on there and let it go in, because we can't have this conversation without you.
And maybe if you're going on vacation somewhere, we could join you.
You know, why not? The more the merrier, right?
Yeah.
Oh no, be careful what you wish for, Catherine. Otherwise, you know, you'll be out there at Disney World and we'll go, which ride are you waiting on? Let's ask her a question about the definition of whatever.
I'm going to be
Alright.
at the Standards Institute on that time, so I'll be at the conference in Denver with the leadership at the Standards Institute. So I will not be attending that day.
Well, we
So I
might need
think
to look at,
yeah, we need to move that date. Can we move it up a week to June 7th?
I'm gone then.
Well, that's why no, just kidding.
Yeah, I'm on vacation then.
Do we try to do May 31st before the school year ends? I mean, knowing that I think our focus there is just any updates that we would have on the 401A, and then just really just trying to not fly through, but, you know, make sure that we get any last, I think we can finish because we would go from 31 to 46 and just
I
checking.
actually
May
am
30,
free that
May
day.
31st is fine.
That's good for me too.
Yep, that works.
Rosie, can you change our meeting to May 31st from June 14th?
Okay, May 31st.
Thank you. All right, look at all that stuff we got accomplished, you guys. All right, well, I'm going to give you back 8 minutes of your day.
Appreciate
Thank
that. Thank
you.
you all.
Go enjoy.
Thanks. Have a good night.
Bye.
Bye-bye.
Bye, everyone.